October 1973. What should have been an ordinary morning starts to feel off. Lines of cars stretch around gas stations, engines shut off, drivers standing beside their doors watching, waiting, not for a better price, but for a chance to get fuel at all. There's no chaos, no shouting, just a quiet, shared realization that something in the system has slipped. A week earlier, oil was invisible. It moved through the economy without friction, reliable, abundant, cheap enough that nobody thought twice about it. Then a political decision made thousands of miles away pulls a single thread, an embargo, and suddenly the entire fabric tightens. Prices don't rise smoothly, they jump. Supply doesn't decline evenly, it vanishes in pockets, and more importantly, certainty disappears. This is where intuition breaks. Because on the surface, this should be the perfect moment for oil companies. The product is becoming more valuable by the day. Demand hasn't collapsed yet. If you follow the logic, this is where profits explode. But that's not what happened. In the early phase of the crisis, the largest oil stocks in the United States didn't surge, they fell. Hard. Roughly 35% wiped out, right as oil prices were spiking. So something doesn't add up. If the companies sitting on the oil weren't the ones winning, then who was? Because in every systemic shock, someone isn't just surviving, they're positioned for it. And in 1973, the biggest fortunes weren't made by owning oil. They were made by controlling whether it moved at all. To understand why oil stocks fell when oil prices exploded, you have to separate something most people instinctively combine: the price of a commodity and the price of the companies tied to it. They don't move the same way, especially not under stress. The 1973 oil embargo is one of the cleanest examples of this disconnect. When OPEC restricted exports, global oil prices didn't just rise, they effectively quadrupled in a matter of months. On paper, that should have been a windfall for oil producers. Higher prices, same product, massive upside. Simple. But markets don't operate on simple when fear enters the system. Because what hit first wasn't profit, it was panic. The broader stock market began to slide almost immediately. Institutions started pulling back risk, liquidity tightened, and when that happens, assets aren't sold based on quality, they're sold based on necessity. Funds facing redemptions don't ask what's undervalued, they ask what can I sell right now. And large oil companies, ironically, were some of the most liquid, most widely held stocks in the market, so they got sold. Not because their long-term outlook was bad, but because they were accessible. They were there. In a liquidity crunch, that's enough. Then come margin calls. Leveraged positions across the market start to unwind. Investors are forced to sell winning positions to cover losing ones. It creates a cascade, prices falling not due to fundamentals, but due to forced behavior. Oil stocks get pulled into that gravity. There's another layer most people miss. Oil companies are not pure bets on oil prices. They are complex businesses with political exposure, operational constraints, and long investment cycles. When prices spike too fast, governments react. Windfall taxes, export controls, regulatory pressure. The very moment these companies should benefit is the moment they become targets. So instead of being rewarded, they're discounted for risk. And timing matters more than anything. Yes, eventually, higher oil prices can translate into higher earnings, but markets don't wait for earnings, they anticipate instability. In 1973, the instability came first. The profits, if they came at all, came later, and by then, the opportunity had already shifted elsewhere. This is the core paradox. In the early stage of a crisis, the market doesn't reward ownership of the resource, it punishes exposure to uncertainty. And oil companies, despite what it seems, are deeply exposed. So while everyone was watching the price of oil climb, they missed something more important happening underneath. Capital was quietly rotating away from the producers and toward the parts of the system that didn't depend on stable conditions to make money. There's a part of the global energy system that almost nobody pays attention to, until it stops working. It doesn't drill oil, it doesn't refine it, and it doesn't consume it. But without it, nothing moves. Insurance. Not the kind you think about day to day, but maritime insurance. The layer that quietly underwrites nearly every barrel of oil crossing the ocean. Every tanker you see on a map, every shipment moving through a choke point exists on one condition. Someone is willing to insure the risk, and that condition can disappear faster than the oil itself. Institutions like Lloyd's of London don't just price risk, they signal it. When geopolitical tension starts rising, they don't wait for missiles or blockades, they adjust premiums. At first, it's incremental. Then it accelerates. War risk surcharges climb, hull insurance becomes more expensive, and eventually a threshold is reached where the math simply stops making sense. At that point, ships don't sail. Not because they physically can't, but because financially they're not allowed to. This is the kill switch, and it often activates before the public even understands there's a crisis. Imagine a narrow choke point, something like the Strait of Hormuz, where a significant percentage of global oil supply passes through. Tensions rise, headlines start hinting at conflict, but before any disruption actually occurs, insurers begin recalculating exposure. If a tanker gets hit, who pays? If a vessel is seized, who absorbs the loss? If the answer becomes too expensive, coverage is pulled or priced so high that shipping companies step back voluntarily. The flow stops, not with an explosion, but with a decision. And that's when prices spike. Because what the market is reacting to isn't just lost supply, it's lost confidence in movement. Oil sitting in the ground or in storage tanks doesn't matter if it can't reach buyers. The entire system is built on continuous flow. Interrupt that, even temporarily, and you create instant scarcity in some regions and oversupply in others. But here's where it gets interesting. The people closest to this mechanism, the insurers, the brokers, the shipping firms, they see it early. Long before equity markets fully process what's happening, insurance markets are already repricing the world. They're effectively front-running the crisis, not by speculation, but by necessity. And when premiums surge, something else happens quietly in the background. Revenue shifts. Shipping costs rise sharply, specialized routes become more valuable, certain vessels, those willing or able to operate under higher risk, start commanding massive premiums. It's no longer just about transporting oil, it's about navigating uncertainty. So, while oil producers are dealing with political pressure, market sell-offs, and operational constraints, another layer of the system is adapting in real time. It's charging more for the same movement, or deciding not to move at all unless the price is right. This is why watching oil prices alone gives you an incomplete picture. By the time prices spike, the underlying mechanism has already been triggered. The decision, the real inflection point, happened earlier, inside a system most investors never look at. Insurance doesn't just protect the market, it controls whether the market functions. And in a crisis, that control becomes incredibly valuable. Because if you can influence whether oil moves, you're no longer reacting to the shock, you're shaping it. Once you see the system this way, the winners start to look very different. Because during an energy shock, the value doesn't just sit in the commodity, it migrates into the constraints around it. And the biggest constraint, almost every time, is movement. When a choke point tightens or shuts down, whether it's the Strait of Hormuz, the Suez Canal, or any critical transit corridor, the global map of oil flow doesn't just pause, it reconfigures. Routes get longer, options get fewer, and suddenly the infrastructure that still works becomes incredibly valuable. Start with tanker fleets. In normal conditions, oil shipping is a competitive, relatively low-margin business. Rates fluctuate, but there's usually enough capacity to keep prices contained. During a disruption, that balance breaks. If fewer ships are willing or able to pass through high-risk areas, effective supply of transport collapses. And when supply collapses, pricing power shifts instantly. Freight rates don't just rise, they spike. Operators who control available tankers, especially those positioned outside the most dangerous routes, can charge multiples of their usual rates, not because they're doing anything new, but because they're one of the few remaining options. In some historical cases, a single voyage during a crisis could generate as much profit as several voyages under normal conditions. Then there are the routes themselves. If a direct path is compromised, oil doesn't stop moving. It takes the long way around. That means more time at sea, more fuel consumed, fewer completed trips per vessel. All of that tightens capacity further. It's a compounding effect. What started as a geopolitical issue becomes a logistical squeeze, and whoever owns the functioning pathways captures that squeeze. Pipelines are another layer. While tankers get most of the attention, alternative pipeline networks, especially those that bypass choke points, become strategic assets overnight. A pipeline that looked geographically inconvenient during stable periods suddenly becomes the safest, fastest route available. And when demand for that route surges, so do the fees. These operators don't need higher oil prices to win. They need disruption. Then you have independent refiners. This is where things get more subtle. When oil flow becomes uneven, different regions experience very different realities. One area might face shortages and soaring prices, while another deals with temporary oversupply. Independent refiners, especially those not locked into rigid supply contracts, can exploit these imbalances. They buy where oil is cheap because it's stranded. They sell where oil is scarce because it can't arrive fast enough. That spread, that gap between regions, is where profit lives. It's not about predicting the direction of oil prices. It's about understanding how dislocation creates pricing distortions and being positioned to bridge them. And this is the part most retail investors never see, because these companies don't tell a simple story. They're not oil up, stock up. Their performance is tied to friction, inefficiency, and sometimes outright chaos. The more strained the system becomes, the more valuable their position. Meanwhile, traditional oil producers face a very different reality. Their assets are fixed, their operations are slow to adjust, and their exposure isn't just economic, it's political. When prices spike, they attract scrutiny. Governments intervene, policies shift. The upside that looks obvious from the outside gets diluted in practice. So while the narrative focuses on oil companies benefiting from higher prices, the actual flow of money tells a different story. It moves toward flexibility, toward access, toward control over movement. This is what you might call infrastructure leverage, the ability to extract value not from owning the resource, but from sitting at the critical points where that resource has to pass. And in a crisis, those points become bottlenecks, which means they become toll booths, quietly, consistently, and often invisibly collecting the highest returns in the system. Every energy crisis feels, at first, like a supply story. Something breaks, a route closes, prices spike. And for a brief moment, it looks like a pure imbalance. Too little oil, too much demand. The natural assumption is that the system will fix itself the same way, by producing more. But that's almost never how it ends. Because the real adjustment doesn't come from supply, it comes from demand collapsing. At a certain price level, energy stops being just another input and starts becoming a constraint on everything else. Transportation costs rise, manufacturing margins compress. Households feel it immediately. Fuel, heating, electricity. What was once background noise becomes a daily decision. And people respond. They drive less, they postpone travel. Businesses cut back on production, delay expansion, reduce hiring. Small changes at the individual level start to compound across the economy. Consumption slows, then contracts. This is what's known as demand destruction. Not because demand disappears entirely, but because it's forcibly reduced by price pressure. The system doesn't rebalance by increasing supply fast enough. It rebalances by making people use less. And historically, this process doesn't happen gently. Look at the pattern. Major oil shocks are often followed by recessions, not immediately, but with a lag. The initial phase is dominated by price spikes and volatility. Then slowly, the weight of those prices feeds into the broader economy. Credit tightens, growth stalls, unemployment rises, and eventually demand drops enough to bring prices back down. But by then, the damage is done. This is where the earlier winners start to feel the shift. Shipping rates cool as volumes decline. Arbitrage opportunities shrink as regional imbalances normalize. Even the most well-positioned infrastructure operators can't escape a system that's contracting. And oil companies? They face the full cycle. First, they're sold off in the panic. Then they deal with political pressure during high prices. And finally, just as things stabilize, they run into weakening demand and lower prices on the other side. It's a delayed squeeze from both directions. This is why energy crises don't create clean, sustained winners. They create phases, short windows where certain parts of the system extract outsized value, followed by a broader reset that pulls everything back down. So the real question isn't just who wins, it's when they win, and how quickly that window closes. So if the pattern keeps repeating, oil spikes, producers stumble, logistics quietly win, and then demand collapses, the obvious question becomes, what do you actually do with that information? Because knowing the story is one thing, positioning around it is something else entirely. Most portfolios approach energy in a very narrow way. They ask a simple question, is oil going up or down? And based on that, they rotate into or out of producers. It sounds logical, but as you've seen, it misses the most important layer of the system. Energy isn't just a commodity, it's a network. And in that network, value doesn't sit still, it moves toward pressure points. So instead of focusing only on who extracts oil, you start asking different questions. Who controls the routes it has to travel? Who provides the infrastructure when the obvious paths break? Who gets paid more when the system becomes less efficient? That shift alone changes how you see the landscape. Shipping companies, for example, aren't just cyclical plays, they're optionality on disruption. Pipeline operators aren't just boring infrastructure, they're alternative pathways that become critical under stress. Even parts of the insurance market, while harder to access directly, act as early signals of where risk is building. You're no longer betting on price, you're mapping flow. And that also means thinking in phases. The early stage of a crisis rewards flexibility and exposure to bottlenecks. Later stages require caution because the same forces that created opportunity start to unwind. Demand slows, volumes drop, margins compress. So positioning isn't static, it evolves with the cycle. And maybe that's the part most people underestimate, because the biggest mistake isn't just picking the wrong asset, it's using the right idea at the wrong time. Back in 1973, most people looked at rising oil prices and assumed the winners were obvious. They weren't. And if the next disruption follows a similar pattern, and history suggests it will, the people who benefit won't be the ones chasing the headline, they'll be the ones watching the system underneath it.